Right. Good afternoon, everyone, and welcome to today's webinar hosted by Husky Workplace Pensions. I'm Guy Waterman, Strategic Partnerships Director at Husky, and I'm delighted to be able to be joined by Sam Laurie, Lead Payroll Specialist at the Pensions Regulator, and also my colleague Olga Sala, Chief Operations Officer at Husky. We've teamed up with the pension regulators today for today's webinar, which we'll split into three parts. Sam will start proceedings by giving an overview and an insight into some of the common themes and issues the TPR are seeing on workplace pensions administration from both an employer's point of view and also their agents, i.e. payroll bureaus, etc. Olga will then give a brief overview on some of the practical issues Husky are seeing as workplace pensions administration specialists and how operational risk can potentially be reduced in this particular area. And finally, we'll open up the floor to any questions you may have for either Sam or Olga. Just as a bit of housekeeping before we start, you should see a Q&A tab on your screen. So any questions that you have during this session, please write them into the Q&A tab, and we'll attempt to go through as many of these questions towards the end of the session. We understand you're all very busy people, so we'll keep the webinar to the 30-minute session that we said we would. So without further ado, I'd like to introduce Sam from the TPR to run through his thoughtful and insightful session. Welcome, Sam, and over to you, sir.
Great, thank you, Guy. Good afternoon, everyone, and thank you for having me. I'm just trying to get my slides up on the screen, so please let me know if you can see those now, your side.
Yeah,
perfect.
Good, sir.
Okay. So as Guy just mentioned there, my name's Sam Laurie, and I'm a payroll specialist at the Pensions Regulator. So I work alongside our compliance and enforcement functions for our employer-facing work, and I also providing specialist payroll support for our inspections. And I also look after our engagement with payroll software and service providers. So today I'm going to be talking about the employer's pensions duties for pensions and auto-enrolment, looking at some of the most common errors that we see when we go out on our employer inspections. So first of all, what are those employer duties when we're looking at workplace pensions? Well, those include the provision of a qualifying pension scheme for automatic enrolment, the ongoing assessment of the workforce, so that's completed each pay period and assigns those workers into an auto AE category. So that's depending on their age and their earnings. Workers will be assigned as either eligible job holders, non-eligible job holders, or as entitled workers. So currently the thresholds are age 22 and annual earnings of £10,000 per annum. That figure is prorated down to match the pay frequency, so £833 monthly or £192 on a weekly payroll, for example. When a worker meets both of those conditions, they are eligible job holders and they must be automatically enrolled. Workers meeting just one condition, either age or earnings, will be non-eligible job holders and they can choose to opt into the scheme. The final category are those entitled workers, who are people that are within the age range but earning less than £6,240 per year. So those entitled workers, they can choose to join the workplace pension scheme, but the employer doesn't have to pay in those minimum contributions for them. Worth saying, you can find the full details of each of those categories and the responsibilities for them on our website. So once a worker's joined the scheme, whether they've been automatically enrolled in or opted in, the employer then must pay minimum contributions into that pension scheme. They must provide those workers with all of their statutory information and issue those within required timeframes, so it's usually 6 weeks. They need to manage their opt-ins, opt-outs, refunds, and any joiner requests. You need to keep the AE records, and that's usually a period of 6 years. And you'll need to submit an initial declaration of compliance to state you're complying with AE rules, and then reassess and redeclare every 3 years. So it's every third anniversary of that initial duties date or staging date. So some of you on this call may either be employers directly, or you may be agents assisting employers with those duties. It's either directly or sort of indirectly. So it's really important that both parties there make sure there's absolute clarity around who is responsible for each task. We quite often see that duties are being missed where an employer has assumed that their agent, payroll provider or accountant or whatever is picking up one of those tasks when they're not. And that's particularly true around declarations and communications. So how do we pick up on these errors when they're made? Well, TPR, we have multiple mechanisms for identifying AE breaches. These include the use of RTI data, so that payroll data submitted to HMRC, reporting coming down from the pension scheme providers, whistleblowers in the workforce, and also employers self-referring if following an audit or something that's identified some issues. We also have an in-house intelligence function, and we work closely with other agencies to identify both individual risks and sort of wider systemic risk as well. So when we find issues, when issues are identified, we have legal powers to demand information. That's through a Section 72 notice, and we have legal powers to enter the premises to find information. It's a criminal offence to either fail to respond or supply any false or misleading information to the regulator. But that said, our sort of preferred approach is always to work collaboratively with the employer with the aim to ensure that all affected workers are restored back to the position that they would have been in had the error not occurred in the first place. Because some of the issues that we're going to look at shortly relate to how a pension scheme was initially configured and set up in a payroll system, for example, that error, when it's set up, when it's from the point of setup, it can sit there undetected for many years. And when that happens, restoring those workers back to the position they should have been in can become quite a costly task because we always go back to the initial duties date or staging date. So it's really important that these issues we're about to look at are reviewed regularly. So what errors do we see employers making? So these are some issues that we come across all the time. Employers across all sectors, all sizes, making these same mistakes. So the first example there is making sure that the pay elements are being defined correctly for both pensionable pay and for qualifying earnings. They may or may not be the same thing. So the definition of qualifying earnings, you can find that up on our website, and it sets out the list of payment types that must be used for the AE assessment, defining the earnings trigger. Many newer pension schemes that were set up explicitly for automatic enrolment mirror those qualifying earnings for their pensionable pay, but there's plenty of schemes out there that have their own unique separate definition of pensionable pay. So when that definition is different, the qualifying earnings set must be used for the AE assessment, and then the scheme's pensionable pay elements must be used for the calculation of the contributions. If you're operating multiple pension schemes on the same payroll, you may then end up in a position where you have several different pensionable pay element sets for each pension scheme. Some schemes will apply thresholds to their pensionable pay, which means that the calculation of contributions into the scheme is based on those earnings in between a sort of upper and a lower limit. With those, they're particularly used for the qualifying earnings schemes, and those limits are reviewed annually at the start of each tax year. So again, it's vital that you're keeping up and keeping on top of any changes there. Minimum contribution rates, again, those have increased gradually over time, not so much for the last few years, but it's crucial that employers are making sure they meet the current minimum rates at least. And just worth pointing out, one of the common causes for missing that we see is where an employer has set up a fixed cash contribution for an employee's pension contribution, rather than having it dynamically calculated in the pay period based on a percentage of pay. So fixing those contributions to be a fixed cash amount means that any change in the worker's pensionable pay can lead to a breach in minimum contributions. So for all of those points mentioned so far, I highly recommend making sure that all of those items are reviewed regularly, and particularly when a new payment type is introduced to payroll, that you're giving that new payment type proper consideration in line with the pension scheme's rules. Another point just worth pointing out here, shouting out here, is timesheets, which have come up quite a few times. where employers have not quite understood how to correctly calculate pension contributions for workers paid by timesheets when they may withhold those timesheets for several pay periods and then submit them all at once. So the rule here is that the calculation of contributions is done at the point that pay becomes payable. So has nothing to do with when the hours were worked and when the money was earned. It's when they're due to be paid to the employee, and that will often be determined by their contract of employment. Be something like paid in the next available period, subject to a payroll cutoff, something like that. So I'm now just going to take a look at another two common issues that we see in a little bit more detail, starting off with tax relief methods. So each pension scheme will have one single prescribed method for employee tax relief. It will either be relief at source or a net pay arrangement. Some pension providers will offer products for both types, and others will only focus on just one method of tax relief. Using the wrong method of tax relief on the workers' contributions can either result in those workers having doubled up tax relief on their contributions, or receiving none at all. So either the worker's losing out or they're getting double tax relief, which can cause real complications. So fixing that can be really fiddly. So it's not just the pension contributions that require correction, but it's also impacting on the worker's taxable pay history and how that's been recorded as well. So just for clarity, how do the two work? Relief at source is our contributions calculated after tax. So they get 20% tax relief, which you can kind of think of being applied to the percentage rate of the contribution. So for every 1% worker contribution due, the worker only has 0.8 of that deducted from their pay. And the additional 0.2 to complete that 1% is topped up directly into the pension scheme by HMRC. Net pay arrangements are a little bit simpler to explain. The worker's taxable pay in that period is reduced down in line with the value of their pension contribution. So if you're paid £1,000 that month, put £100 into the pension, your tax is calculated on that remaining £900. So when pensions are contributed via salary sacrifice, the base scheme sitting behind that is still either a relief at source scheme or a net pay arrangement. It's just because the employer is making the entire contribution on the worker's behalf that there's no tax relief there to see on the worker's contribution. It's simply because the worker's not actually making a contribution themselves. My final slide is a real common issue. We see this one come up time and time again, and even on our inspections when we go out and look at the sort of largest employers in the UK with professional HR teams and stuff in place. So what I can give here is a bit of a rule of thumb to follow. So in pension contributions in maternity leave, as a rule of thumb, the employer's contributions should be based upon the pay that the worker would have received had they not been on maternity leave. So for salaried workers, that's quite straightforward. Just look at what their normal salaried pay would be. But for variably paid workers, a method of calculating a notional normal pay figure needs to be applied first. So there's no particular method that's specified in legislation for this. So that means the employer has discretion there to determine what the most appropriate way is to calculate this for their own workforce. So typically you might see something like an average of pay over the last 6 months or 12 months, for example. Sometimes the average weekly earnings are used as that figure's already been calculated. Whatever method's used, as long as the employer can demonstrate the method is fair to the worker and meets the intentions of the legislation, then that will be fine. On the employee side, there's no such rule to maintain contributions on that notional full level. Therefore, these are typically based on the actual pay received in the period. An additional consideration there is just looking at salary sacrifice, so there'll be periods where the worker may be receiving statutory maternity pay, SMP only, where there's no salary available for them to sacrifice. So in these situations, the employer has still agreed to contractually pay over that full percentage on behalf of the employee. So even though the worker's not sacrificing any salary, the employer still has that responsibility to pay over that full amount based on that notional full pay. And just to say again, this is a rule of thumb. There are certain exceptions to this rule, in particular with defined benefit schemes. So it's always worth checking the pension scheme rules just to make sure that you avoid any doubt there. That concludes my presentation, so I'll hand back to you.
Thanks, Sam. That's a really useful, insightful presentation, and appreciate your thoughts and comments on that. So yeah, Sam makes some really interesting points from a TPR perspective, and I'm sure a lot of that will resonate with a lot of people on the call this afternoon. Just turning to you, Olga, from a workplace pensions administration specialist point of view, what are some of the common themes and issues that Husky are seeing when taking on and administering employee pension schemes? Just give some thoughts on that if you can.
Yeah, of course. Well, first of all, hi everyone. I see some familiar names on the attendee list, so that's always nice. And thank you, Sam. I'm going to talk a bit about exactly, very briefly, what we see at Husky as workplace pensions administrators on the typical issues. And it's quite similar to what you touch on, Sam, which, maybe good or bad. But I guess the main thing is contributions uploaded doesn't mean it's compliant. And again, probably on where you were touching on, Sam, we find that in a lot of cases, there might be employers that are actually submitting the data every month. But when you look at it, there might be some non-compliance. Actually, we find that around 40% of clients that, come to us from partners or approach us have some sort of non-compliance. And again, that can be obvious non-compliance, like a scheme that hasn't been set up, or it could be some form of non-compliance, for example, statutory communications not sent or stored, some of the specifics that Sam was also touching on. So what we say are the main common patterns that lead to non-compliance is generally historic setup never reviewed. Again, quite typical that, maybe the employer set up the scheme themselves, or someone on the HR team or an IFA years ago that went to payroll, was configured wrong, and then years later you realize that that was not correct. No monthly reconciliations, no monthly checks. Pensions is usually not part of that, so it's kind of missed. And what we find also is the ownership. So sometimes there's no clear ownership on workplace pensions per se. So you might have payroll doing the calculations, the employer sending some comms, HR actually doing communication, someone else doing the declaration. So some tasks are missed. So the kind of all is the set and forget approach, as we call it. Contributions are paid, so the problem is not there. But actually, when you look in more detail, there might be. In practice, these are some of the issues that we typically see. Again, we're going to send the slides. So, I'm not going to go through all of them. Do not worry. But reiterating a bit what Sam said, that we actually also see when we do the administration for our clients or clients that come on board. On the setup side, typical one, that the pension is never set up. We get that a lot, an employer that had an employee that joined months ago and said, well, I know my employee doesn't want to be in the pension, so I never set it up. And, some might agree that sometimes the process is not very straightforward, but what they actually need to do is still set up the scheme, still enroll the employee, and then the employee has to opt out. So even if as an employer, your client or the employer thinks their employees don't want to be in the scheme needs to be set up. We find that quite a lot as well of declaration of compliance myths, even companies with multiple directors, those typical scenarios. And even the ones that set it up maybe late, 6 months, 1 year later, what happens a lot is that they do not backdate. So again, that full year that the employee was not in a pension, still needs to be backdated or contributions recalculated, right? So we find that that's a typical one as well. And then the one that's both a setup and an ongoing issue is the incorrect configuration. We find that a lot when we take on the legal access of existing schemes. The scheme is sometimes set up as tax relief at source and payroll had it configured on net. or the scheme is on pension pay set 1 and they're calculating on qualifying earnings. And as Sam touched on as well before, that's a lot of rectification. So that's not a simple process afterwards. The wrong pensionable earnings included, we see that as an ongoing thing as well. Again, schemes that are on pensionable pay set 3 and not everything is included or tick on payroll as pensionable. And then might not talk about the pensionable pay set too much, but that's a very typical one, that 85% rule. Generally, if it's not checked regularly, you find that has been wrong many, many times. We touch on the statutory comms. They need to be stored for 6 years. And again, that sometimes doesn't happen. The declarations, redeclarations. But the salary sacrifice, as Sam said, is a typical one that we see. Not only on the calculation side, but also on the contracts side letters. So we have sometimes clients coming to us that supposedly they have salary sacrifice, but there's no contracts, there's no agreement. So the agreement says something totally different than what's being sacrificed or exchanged. And then, you still have employee contributions going to the scheme and I reinvestment calculated wrong. So this happens quite a bit. But yeah, last one, basically the DD failures as well. Again, what happens sometimes is that, contributions are being uploaded, but the direct debit with the pension provider failed. Sometimes payroll wouldn't realize, the employer doesn't either. And what happens is that the pension provider reports the client to Sam and the team because contributions haven't been paid. So things like that also need to be monitored. And just to finish, most of you work with us either way at Husky, but so you might recognize the mismatch screen. But basically what we do for our clients and what we recommend that's been done regularly is, that payroll configuration review, the monthly compliant reconciliations, the checks, and, have one person or one team that manages everything to do with pensions, so it can all be managed by one group. And I guess the main thing is that workplace pensions are not just a one-off submission or a monthly submission. It's also a monthly process and a monthly reconciliation that should be done, so we don't find these issues after years, which is what unfortunately sometimes happens. But yeah, I'm conscious of time, so Guy, if you want to check if there's any questions.
Okay, thanks, Olga. Some really interesting points you make, and also thanks to Sam for the points that you make, both from a regulatory and a practical point of view for both employees and payroll bureaus to consider going forward. As Olga said, conscious of time, I'd probably like to open the floor up now to any questions. We don't seem to have any in the Q&A bank at the moment, but is anyone from the floor wanting to put their head above the parapet and ask a question to either Sam or Olga?
I see Larissa has asked about some checklists as well on the chat. Well, I think Howard asked for the slides. So yeah, we will definitely be sending those, I think.
Anyone got any questions, to Sam or Olga that they want to raise? I've got a couple that we've pre-prepared, Sam. So
I think we can take
Larissa's
a query there about what to check when switching payroll or pension providers. So just answering that one that's there in the chat.
Sorry, it's in the chat.
Those points that we went over earlier, really, a lot of that configuration, we see it time and time again. Someone's come in and they've inherited how things were configured and they've been trained to do it this way by the person before them. And it just gets taken on and people just assume that that's right. What I could really encourage is just making sure you go back and check all of those things that I went through in my presentation. So check the tax relief methods, check the pensionable pay elements are set up in line with the scheme rules. If you're taking on an employer and they're not really giving you that information, challenge them, push back and say, make them aware that there can be big cost implications for not getting this right from day one. And it's in their interest to contact their pension provider and find these things out. it can cost them a lot more in the long run if they leave it wrong. So yeah, check those thresholds are in place and at the right level, check the contributions are right, check the element sets are right, check definitely that the tax relief method is right.
Okay, thanks, Sam. Yeah, both Sam and yourself, Olga, mentioned about salary sacrifice, and salary sacrifice becoming more common now, particularly with employers looking at NI efficiencies. Are there any areas employers should particularly be careful of from a compliance perspective, Sam?
Yes. I mean, there's a few. Olga touched on the contractual side, which I won't go into, but the treatment of salary sacrifice in periods of maternity leave is one we see a lot. And another issue that's probably more prevalent over the last few years is the sort of interplay between national minimum wage and salary sacrifice. Obviously, if you're running a salary sacrifice to pension and that contribution would pull you below the national minimum wage, it can't be made, but you still have an obligation to pay over that minimum contribution rate. So you need to have a plan into place what you're going to do in those situations. So, if as you've signed a contract with the employee to say we will pay those contributions over, the employer could pick up that bill and pay over the entire employee amount into that scheme. Another alternative that we sometimes see is a temporary reversion of the worker's contribution to be either RAS or relief at source, depending on the scheme type. But obviously there's, as Olga alluded to, there's contractual considerations around that as well. But you need to know what you're going to do in that situation, and there's no sort of one size fits all for that.
Yeah, exactly. And what we find sometimes the confusion as well, like not everyone has to be on salary sacrifice. So as you said, Sam, salary sacrifice, the backing of the scheme, let's say it's still net or tax relief at source. So you could have employees that are not opting on salary sacrifice. So you're running both a calculation method. So we find that sometimes that's a bit confusing as well.
Yes, of course, the worker can opt out of that salary sacrifice contribution. So you need to understand what the underlying scheme is. Yeah.
Okay, thanks both.
I think
question from Larissa. Are there any upcoming TPR enforcement focus areas for 2026? Probably one for you, Sam, I would have thought.
So there are plenty. So I mean, I specifically work in the employer-facing sector, so I can only really comment on that side of our work. But what we do, sort of as a regular exercise, we go out and see all of the largest employers operating in the UK, sort of working on the basis that if they're getting something wrong, that's hundreds of thousands of people affected. But also all the sort of professional bodies and payroll providers sort of disseminate that information downwards from the large employers. But on a quarterly basis, we have a much more sort of intel-led approach where we'll pick a sector per quarter and really deep dive into it. So that will be getting in touch with all of the trade bodies in that sector, going and seeing employers across all sizes within that particular sector, identifying any systemic issues and making sure that we feed those back and get that information out there. So we go through sector by sector, region by region, and also looking at all of the larger ones, as well as the sort of more ad hoc stuff that's based on actual data of non-compliance.
Thanks, Sam. I'm just conscious of time. I think we're out of time now. But before we finish up, Sam, quick question for you. If there was one thing employers, payroll teams could do to start doing immediately to reduce pension compliance risk, what would that be?
So I think it's everything that we've said today. It's go back and check. Don't just assume that you've inherited the scheme you've inherited has been set up correctly and is running fine. It could be a case that it was set up correctly in the beginning, but requirements have changed over time and it hasn't kept up in line with that. So just make sure that you've got methods in place to check that configuration is correct, and you're reviewing that regularly to make sure that you're staying in line with changing legislation.
Thank you. Thanks, everybody. I think that's probably it from today. I'd like to thank both Sam and Olga for their insightful sort of talks this afternoon, and many thanks to everybody that joined today's webinar, and I hope you found it useful. We will be sending out a recording of the webinar, and if you have any further questions you'd like to ask, then please feel free to contact either Sam, Olga, or myself, and we can talk to you on a one-to-one basis. But that's it from us. We've kept to the 30 minutes, I think. Thank you, everybody, and have an enjoyable rest of your day. Many thanks.
Thank you, everyone. Have a nice long weekend as well. And thank you, Sam, for joining us.
Cheers.
Thank you.
Thank you.
Bye.
Bye.